Welcome back. This will be the last video of the entire year. Thank you guys so much for the support recently. In today's episode, I'll be doing a new year wrap up covering my biggest winners as well as my biggest losers, as well as my watch list going into 2026. This is my portfolio over here. It's the most updated version, and I've recently added into some positions like Visa as well as MasterCard. I've disclosed these positions on this YouTube channel as well as our newsletter, so feel free to check it out. I feel quite comfortable with the positions here, but of course there is a very common risk, which is your AI risk. If it goes into a bubble, who knows? And I've Meta, Microsoft, Amazon, Google, ASML, all these companies are heavily tied to AI. So I'm actually looking for a way to try and diversify out of that trade. As for the entire portfolio as a whole, this is the performance this year. So year to date, it's up around 40%. This is, I believe, without adjusting for FX risk. FX loss, of course. So I'm in Singapore and the USD against the SGD this year is quite weak. So this 40% is a lot more inflated than what it actually is. It's probably around 30+%. And I'll be covering my biggest winners as well as my biggest losers this year in the next part. Okay, so this wasn't a loss-making trade, but I feel this is my largest mistake this year. I started adding into United Health around $400 a share, and then I added all the way down until around $239. I think the problem with the mistake over here wasn't because it wasn't a good company. United Health is a good company. It was simply because I didn't have the conviction holding it through. I don't think I did enough research for the company. And United Health as a whole is a very complex business in a very highly regulated segment of the entire economy. That was one portion that I felt was a big mistake. Luckily, I made it out good, and hopefully you guys don't make this mistake, and I probably will not make this one anytime soon. So this wasn't a mistake, but this is my largest loser this year. It is Copart. My entry position was at around $45 a share, so I think I'm down around 15% on this position. And for Copart, it's a company that is undergoing some form of sentiment headwind because of tax loss harvesting, because of AVs, because of slowing growth. But it's a quality compounder, and over time, I think this company is a decent quality company to hold for the long term. I'm not too concerned with this one. I'm actually looking at entering into more Copart positions if the company provides me with an even larger margin of safety. So we'll see how this one plays out. As for my largest winner this year, it is Google. So Google is up around 65% this year. For Google, the thesis was simple, but the catalysts were unexpected. The thesis was one that was driven by ChatGPT as well as Google. It is on the basis that Google will not lose its share to ChatGPT because of higher switching costs, because Google monetizes in ways that are different from ChatGPT. But of course, Gemini came in and then all the catalysts started piling up, and then as a result, Google is up around 65% this year. So I'm not complaining. My second winner this year, my second largest winner this year is ASML. This is another company that was depressed last year, and this year it has seen a resurgence. So the stock is currently trading at a 37 times of earnings. And for ASML, it's a quality business, of course, but I'm actually looking at trimming this position along the way. I think there's significant risk associated with companies that sell hardware. In the case of ASML, there is extreme cyclicality as well. So you need to make sure you time it well. You need to make sure you time your positions well. If not, your returns from this company will be subpar. For ASML, it's a quality business, somewhere around $670. That was when I added a large chunk into ASML. It has turned out well, and hopefully this quality business continues to compound. Next portion, I'll be covering some stocks on my watch list going into 2026. So the first company is Netflix. Netflix is up around 6% year to date. At one point, it was up around 40%. So it's down around 30% from the highs already, currently trading at a 39 times of earnings. For Netflix, the thesis is an extremely simple one. It's just the company pushing out the ads division portion in all these different countries over here. And based on some model math, the company is currently earning more money with the ad division as compared to the normal non-ad tier. Based on a CPM of around $20, which is what is reported by Netflix, and assuming the non-ads tier remains at $17.99, this is for the US, currently the ad tier revenue is closer to around $23.37. What that means is that ads is bringing in 30% more revenue for Netflix as compared to the non-ads tier. With the company rapidly trying to push this ad division, with around 65% of new users currently signing up for this ad tier, this could be a revenue driver for Netflix going into the next few years. And of course, there is your other tailwinds as well, like your secular tailwinds in all the different segments over here. So Netflix is currently underpenetrated in most of these countries outside of North America. And based on the numbers over here, I got a fair value for Netflix of around $180 a share in 2030. It's around a 13% CAGR from today's price. Of course, a lot of it depends on this exit multiple over here. We could see even more compression as Netflix becomes more mature. But I think the overall revenue profile for this company, the growth into the future is very strong. All these model numbers over here are following the trends in all those different segments apart from North America, where I included some ad gains as well as some market share gains. But overall, I think Netflix growth profile is extremely strong. And if the company provides me with a better opportunity, I think around $85 a share is good enough for an entry. I'll be looking to enter into Netflix shares. And this is our Substack. Oops, wrong screenshot, 120 subs. This is our new Substack account. Thank you guys so much for subscribing to it. It's around 300 subscribers right now. Hopefully we get to 1,000 by 2027. Next company on my watch list is actually Mercado Libre. I've been talking a lot about this company. It's me filtering out my biases, trying to do a bit more research. And currently Mercado Libre is up around 13% year to date. The reason why I dislike the stock, the portion of the business that I don't really like is this portion over here, which is ironically the biggest growth driver for Mercado Libre in terms of the company's operating income. It's the Mercado Pago portion. The Mercado Pago portion is a fintech arm for Mercado Libre. It is the one that creates the entire ecosystem, the closed loop ecosystem for Mercado Libre. But the problem with this Mercado Pago portion is that it is impossible for you to assess the creditworthiness of this entire arm over here. The only way for you to do it is through quantitative numbers, which is to check for the non-performing loan increases over time, to check for how much they are increasing their provisions for doubtful accounts, to check for the ratios and all that. And overall, I think buying into Mercado Libre is more of a bet on the management rather than hard facts and hard numbers. For Mercado Libre, this is what I found in their 10K, their annual report. So over here, it says that their financial assets, their books in Chile is actually securitized. So what this means is that they sell away their books so they don't have to absorb any losses in Chile only. As for the company in other regions, like for example in Brazil, in Mexico, in Argentina, they don't really securitize their loans, meaning to say that if they lose money, if their consumers that borrow money from them start to basically not return the money, start to default on their loans, then Mercado Libre is going to have to absorb all those losses instead of pushing it to someone else, instead of making it risk-free for the company. So I've actually read more into the company, and this is what the company does to try and reduce the risk of defaults as well as non-performing loans. So they basically do something equivalent to an incremental loan system. So what that means is they will lend a bit of money and then they'll make sure that the consumer returns the money first before they increase the amount. So there's a limit to that. And besides that, in terms of your merchant credit is quite credible because they just take the money from the revenue that the sellers generate directly. So there's no need for Mercado Libre to go to those merchants and try and get the money from them directly. It's basically from the store. Merchant's portion is less risky. I'm a bit more concerned with the consumer portion. I'll be digging more into this company, and when I add it, you'll see it on the Substack. Last company that is piquing my interest slightly is this company called Universal Music Group. Universal Music Group is down around 9% year to date. And based on valuation, the company now is currently trading at a 24 times price to free cash flow. Their closest competitor, which is Warner Music Group, is currently at around 22 times. Spotify is at around 35 times. So Spotify is still trading at a decently size premium as compared to Universal Music Group. For Universal Music Group, they currently hold around 30% of the market share in the music industry, and they make money from many different sources. So they have their royalty deals, they make money from streaming platforms like Spotify, for example, whenever they have their artists on their platform. And for Universal Music Group, they have a lot of different artists and very strong content IP, music IP basically. They have Taylor Swift, they have BTS, they have Drake, some of the more notable ones. And for Universal Music Group, besides the scale advantages, so that's one of the moat. The second one is their content IP, their music IP. So similar to what Netflix has content IP whereby some of the older shows from Netflix can suddenly blow up because it becomes trendy on TikTok. Universal Music Group has something similar as well, which is that some of the old music can suddenly blow up whenever it goes viral on TikTok. So it's basically free marketing for this company, and the content IP is one that will continually bring in revenue for the company year in and year out. I think for this company, it's similar to buying a bond. If you buy the company cheap enough, you get decent sized returns. Of course, you can't expect a 2-bagger, a 3-bagger from a company like Universal Music Group, but it's definitely a decently priced defensive position in this elevated market today, and that's why I'm actually looking into this company. You will see it on the Substack if I initiate a position into this company over here. Anyways, thank you guys so much for the support this year. Hopefully 2026 will be a lot better for all of us. And we started the year with slides, so I'll be ending off with slides as well. I know the video qualities at the start of the year wasn't very good. So for 2026, I'm aiming to elevate the video quality, to introduce even more research, to try and delve deeper into the companies, try and provide more value on this platform. So hopefully you guys stick around by then. I hope you guys have found this video useful, and I'll see you in 2026.